Hello, everyone, and welcome to Beyond the Bell, Navigating the Path to Public, presented by Fidelity. My name is Melike Atıl, and I'll be moderating today's discussion. As companies eye the public markets, they're facing shifting investor expectations, new regulatory demands, and the challenge of keeping culture intact through transformation. Today, we'll explore what it really takes to make that transition successful. Let's meet our panelists. We have Emily Sarvino, Head of Industry Relationships and Thought Leadership at Fidelity Investments. She brings a broad perspective on market trends, equity compensation, and what companies need to know from a structural and regulatory standpoint. We have Bianca Buck, Head of Investor Relations at Hinge Health, who helped guide the company through its IPO this year, and she will share insights from the investor-facing side. We have Raul Willer Jr., the CEO of Audit Board, and he brings his experience leading Paycor through its IPO in 2021, and he'll share lessons in leadership and readiness from the CEO's chair. His company, Audit Board, provides services for connected risk, transforming audit and compliance. Thank you all for being here today. I know our audience is getting eager to hear your insights. So, shall we start right away? Let's start very broad, if it's okay. Emily, from your perspective, how are companies approaching this wave of IPOs differently than in the past cycles, especially when it comes to equity, cap table readiness, and compensation planning?
Well, thanks. There's really a lot to kind of unpack here, but let me just start by acknowledging that Fidelity is deeply embedded in many aspects of IPOs and, of course, of public markets, from institutional investments to our capital markets team, which creates demand in retail channels, to our stock plan and our stock transfer businesses, and really much, much more than that. Today, I really want to focus on how we help companies on the road to IPO with their equity compensation needs. The stock options, stock, restricted stock, stock compensation is such a critical tool for companies in the startup phase. And this type of compensation is really dramatically impacted by an IPO. So that's the area that I think I'll really focus on today. And I think we all know that the past 5 years have been a little bit of a wild ride in the IPO space. 2021, all-time record, followed by a pretty precipitous drop in 2022. And now what we're seeing is that companies are staying private longer, which means they have a longer runway to get ready for IPO. And I know that that might be hard for founders and investors and employees at times, but the silver lining here is that the longer a company is private, the better equipped they can be for IPO. Because IPO readiness does extend well beyond valuations and roadshows and investment bankers with this critical focus on employee compensation. We all know how important this is in the startup environment. I sometimes think of equity compensation as the pixie dust, like the magic that propels these ideas into existence and ultimately a market debut. And at Fidelity, we work with clients and companies during this transformation by ensuring that their compensation strategy and their systems are in place to not only avoid any unexpected issues, but also to really set them up for long-term success with their human capital needs. Now, with respect to trends in this area, I would say one thing that we've definitely been seeing is that companies are really realizing they need to work with a trusted partner sooner rather than later. IPO readiness is not a do-it-yourself project. And believe it or not, 18 to 24 months, really even just thinking about the compensation elements of it, is not too early to get started in IPO readiness.
Thank you, Emily. And How about investors? Let's talk about that. Bianca, how have investor discussions evolved over the last few years, especially given all the market volatility?
Yeah, of course. First of all, thank you for having me here. I'm excited to get into the discussion. But having just gone through the IPO process here at Hinge Health, we've had the benefit of meeting investors multiple times over the past few years. So we've really seen the tone evolve over that time period. A couple of years ago, as Emily mentioned, the bar for going public was incredibly high. Investors were very selective, and those companies that did get out, frankly, had some mixed reception. We saw that start to change late last year, which opened up the opportunity for companies like ourselves to start a formal process. And luckily, ultimately for us, get public earlier this year. Fast forward to today, it does feel like the environment is much more risk on. Investors are eager to put capital to work. They're generally looking at new issuance opportunities, albeit with more scrutiny than maybe in the 2020 or 2021 era. They're not going to participate in everything. We've definitely shifted away from a growth at all costs mindset towards more growth with profitability, or at least a line of sight to profitability. So because of that, it makes it critical to have a differentiated story and financials to really stand out from the crowd. At the same time, companies can only stay private for so long. Employees and early investors expect liquidity, and there's also a real sense of pride that comes with being a public company. It also validates your business, makes you more reputable with your customers, and broadens your access to capital. So couple this with the fact that many companies have either grown into their valuations that they raised at, 3 or 4 years ago in the private markets, or the valuation reset has become a bit more palatable over time. It's making it feel like the right time for many companies to start the process.
As you have experiences yourself, why do you think companies are considering IPOs now after staying private longer?
Yeah, I got into it a bit in that response, but I think it is just a mix of external factor pressure. They're either their investors or their employees that have been with them for some time expect some sort of return, coupled with the fact that the market's in a little bit of a better place. You've seen some companies go out, like ourselves, and trade decently well in the markets. Valuations may not be what they were back in the peak of 2020 and 2021, but it's starting to feel a bit more palatable for them. So I think it's starting to look like a better market to get ready for.
That's right. Thank you, Bianca. So, Raul, Bianca said it's a better place right now. From your audit board perspective, what are clients most unprepared for? Let's look at the other side, right? For when considering the IPO path today.
Yeah, I think the biggest component that we continue to see is that companies underestimate what is required to become a public company. And Emily mentioned it early on, 18 to 24 months. It takes a village to become a public company. And you need to think about, do you have the right people in the right seats that have been a public company before? Do you have the right tools and technology to drive a public company? Do you have the right compensation packages that are going to enable people to transition from a private company to a public company and see the rewards that go through it? And I believe that it takes a significant amount of time. And from my own experience, taking Paycor public in 21, so we were at the peak of growth at all costs in 21. When we went public, I walked out after pressing the bell on the NASDAQ. My private equity investor, he said, "Hey, what's wrong?" And I said, "Nothing's wrong, but 90 days from today, I have to have my first public call." And that's when reality hits, because there's a lot of excitement about becoming a public company. A lot of what Bianca said about pride within the organization, delivering a return to people that have been with you the entire journey, is really exciting. But the minute you go public, life changes. And you have to be able to systematically deliver results on a quarterly basis while rewarding your associates. And it's that fine balancing act that is really hard for a CEO to manage by himself or herself. And as Emily said, it's critical to surround yourself with the right advisors that can help guide you through that process, because you can't do it by yourself, and your team is focused on executing as a public company, and they can't focus on all the things that are required to be successful in that environment.
So true. So how does the life change for the investors? Let's shift to the investor expectations, shall we? Which is always a very hot topic. Bianca, is Hinge prepared for its IPO? What kinds of questions or concerns are investors raising, and how do those expectations shape your communication strategy?
Yeah, so we had a bit of a unique challenge during our IPO process in particular, as we were trying to redefine a category that had struggled in the past. A lot of investors had been burned in digital health, so there was understandable skepticism when we came to market. On top of that, we straddled two verticals. We are very much a technology company that operates in the healthcare space. However, some investors, before meeting us, maybe tried to bucket us into what they were more familiar with without knowing the story. So we had to be very intentional about both how we conveyed the story, but also ensuring that we were meeting the right people. We wanted broad coverage across both the tech and healthcare landscape on both the research side as well as on the investor side. So to get that, our IR strategy really centered on engagement and credibility. We made a point of going out early and going out often. We attended both healthcare and tech conferences, did multiple non-deal roadshows and testing the waters meetings, and stress tested different KPIs with investors during that process. We also hosted a broad investor day during our IPO process, which is not always typical during an IPO process, with various leaders at the company to really showcase Hinge Health and the bench of leaders that we have at the company. We also, through that, set up product demos so that we could give investors a firsthand opportunity to feel what our product was like and what we offered. Come IPO, for some investors, it was our 6th or 7th time meeting them, which gave us a lot of credibility because we had that track record of saying what we would do and then delivering on that. And it didn't hurt that the fundamentals of the business along the way kept improving. We were showing a reacceleration of growth and generating a profit now that we weren't the first time we met them, which really differentiated us from some of the prior names in the space. So by the time we went out, investors were ready to lean in because we'd seen them consistency, they'd seen our execution, and we had built that trust over multiple years with them.
It sounds like you did create a very fine balance to create that trust. And Raul, which brings me to you again. How do you advise leadership teams to strike a balance between ambitious growth and investor demand for resilience?
Yeah, it's a great question. And I got some really good feedback from some of the advisors we work with prior. We did a crossover round first before we decided to go public, which attracted, we did a non-deal roadshow, met with all the institutional investors. But the banking partners that we worked with said, whatever you put on paper, you're going to have to execute against. And you have to balance like your ambition with reality, because as a public company or a future public company, people want to be able to trust that you're going to be able to beat and raise on a consistent basis, that you understand the dynamics in your business, that you understand the macro impacts to your business, and that they can count on you to deliver what you forecast the previous quarter. And so I think it's critical that the management team stay within their boundaries, that they don't get overexcited about trying to get a high valuation initially, because if you're building a great business, great results will happen, and you should just focus on that.
Boundaries is right, and which brings me to regulation. Can I switch to regulation? And I cannot have a better expert and advice giver than Emily here, because we all know regulation is another area that can get messy. And Emily, what are some of the overlooked complexities, let's say, like lockups, share class conversions, or employee tax mobility that often trip up companies preparing for the IPOs?
Well, I think Raul's closure of boundaries is the perfect segue into this, because there's an awful lot to address here. Our stock plan team at Fidelity affectionately refers to this as leg reg. We've got a whole team that focuses on the legislative and regulatory changes and developments that impact equity compensation and how companies can offer it and what it means for them and their employees. And stuff changes in the space all the time, especially on a global landscape, which impacts a lot of companies who are offering equity to employees outside of the United States. For a soon-to-be public company, there is a whole host of regulatory reporting, shareholder and disclosure requirements that's going to require a pretty steep, quick ramp up right at the beginning. But I don't want it to all seem overwhelming, because we should also acknowledge that the time before a company goes public is really a unique and limited window for companies to equip themselves for compensation success as a public company. Before IPO, companies really need to do a deep dive on what their compensation strategy is and understand what they're going to need to deliver that as a public company. And the great news is that as a private company, they're well positioned to put in place the plans that they need with the provisions that they need. Public company stock plans are subject to shareholder approval, and public company shareholders have a lot of concerns around dilution and the impact of these stock programs. So the window before IPO is really a fantastic opportunity to establish and approve new plans while the company's still closely held, which is way easier than waiting until you go public and then trying to approve new stock plans. It also means that, these plans should be designed with what I call like an everything but the kitchen sink approach to deliver maximum flexibility, because public company needs change. So what you need right after IPO may not be the same things that you need 2, 5, 10 years down the road. So really designing plans with flexibility is key. And approving these new plans before IPO also means that companies can embed an evergreen provision into their stock plans, which automatically replenishes the share pool. Now, this is a feature that public company shareholders are unlikely to approve. So this pre-IPO window is a great window to implement plans with great features for companies. And I'll also just put in a plug for ESPP, one of my favorite topics. Hopefully we can talk about that a little bit later on, but particularly in life sciences and technologies, we're seeing almost every company put an ESPP in, approved and ready to go. They don't all launch it on IPO, but almost everybody has one approved and ready to go. So now let's drill in on a couple of the specific things that you mentioned. And the first is lockups. We all know that IPOs traditionally have a 6-month lockup. Now, this is well-intentioned. It's certainly prudent to prevent a sudden flood of shares onto the market that could really destabilize the stock price, undermine confidence, create a bunch of ripple effects there. So the intention of a lockup is really good. But what we've seen in recent years is a notable rise in non-traditional lockup provisions. So this is what we would call an ELR, or an early lockup release. An early lockup release allows a portion of the shares to be sold before that 6-month period is up. Now, there's a bunch of variability in how companies can design these, but regardless of how it's designed, a really important and significant byproduct of these ELRs is that companies can't count on that 6-month window as a safe haven, as time to upgrade their systems and their staff. Companies that are looking to go public really need to make sure they have all the systems and all the staff and all the providers ready, potentially for day one trading. So that's a really important consideration with early lockups early lockup releases, ELRs. Another area that you mentioned is share class. And we deal with this a lot with our clients. So we see it often for companies approaching IPO and after IPO that they're working with the dual class of stock. And those Class B shares, they often provide really high vote rights. That's really super important for founders. That can be a really critical way for them to help maintain control. But for average employees, holding Class B shares is kind of a hindrance to their liquidity. So what we really see with a lot of our clients and talk to them about is potentially automatically converting Class B shares to Class A for rank and file employees. That can really improve the employee experience in accessing liquidity when they're ready. So I would definitely say that working with a provider to help you identify and address many of these often overlooked or underestimated complexities can really help to set you up, and your compensation plans set you up for success.
Thank you, Emily, for that valuable, insightful advice related to those IPOs, which stuck with me is the flexibility, the timing, the strategy, and it has to be before the IPO, and the planning, which is all. And you said something interesting about the lockups, waiting until the lockup, which brings me to Bianca. Bianca, what was Hinge's decision to net share settle RSUs at IPO versus waiting until the lockups?
Yeah, and what Emily just walked through gave me a bit of PTSD, so I know how much work went into all of that, having just gone through it myself. So one of our priorities was to get some early shareholder liquidity, or employee liquidity, I should say. And so we did want to do a partial early lockup release. And in order to do that, we had to double trigger vest. There's a whole bunch of jargon I won't get into, but we had to essentially pay for our employees' taxes at the IPO so that those shares could convert and that they would be able to sell some within the typical 6-month lockup period. So this is one of the most important pieces of the IPO process, is deciding how you want to handle the RSU vesting and the associated taxes with it. Because we had, as a company, been offering RSUs for quite a bit of time, and I think that's the case for a lot of private companies out there that may have stayed private for longer than they expected. There is quite a substantial tax bill that comes with the vesting of those RSUs. You have two main options, at least this is how we thought through it. One is to do it at the IPO, cover the employee tax liability upfront, often through the net share settlement, or you can defer that to the lockup expiration at the end of that 6-month period. Every company has different goals. There's no one-size-fits-all model, so it really depends on what your objectives are. But for us, it was important to have some liquidity for our employees, and we were also fortunate to not need the cash ourselves at IPO, given we had over $400 million on the balance sheet. So that's why we opted to use a net share settle process, where any of the primary proceeds that we raised at the IPO, we settled our employee RSU taxes, delivered that cash to the government, and then that allowed us to do an early or partial early lockup release for a percentage of our employee shares at day 90. It aligned with our philosophy of rewarding our employees for the value that they'd helped create, while still maintaining a strong balance sheet for the business.
Yeah, and I'll just add on there that these are really important conversations that companies have around their programs. Like, I think sometimes it comes as a surprise to some of our clients who maybe are not as well prepared that, these are taxable events. And depending on how your plans and your awards have been granted determines the timing of those taxable events. And across the board, I would say, most companies do use net share settlement, but the kicker here is that, of course, the IRS doesn't take shares, they only take cash. So for companies who are net settling, they do have to be prepared to cover the tax payment for their employees. Now, I will say that we do sometimes see a net settlement for these early lockup releases, and then a company may pivot to a sell to cover arrangement after the lockup has completed, because that will free up more cash for investment in the business. So it's not a single decision. Companies may need to make multiple decisions about how they're covering the tax liability, and that changes as their company needs and priorities change.
Thank you so much, both of you. Sorry for reminding you to PTSD, but Bianca, these were real-life examples that our audience is very eager to hear, because you made it sound very, very easy. And same with you, Emily. Thanks for sharing that experience from your own. And I want to ask Raul from audit board's perspective, meaning how is audit board using compliance expertise to help companies navigate regulatory scrutiny in 2025?
Yeah, I think the most important thing, as we talked about earlier, is being able to successfully operate a public company once you get there. And what we do is we provide companies pre-IPO advice. We help them prepare to go public. We provide the systems and tools so they can effectively audit and provide SOX compliance when they go public. But we also help them manage their risk, which they have to provide in all their SEC reporting. And so we provide a tool set that enables someone to go public. And then once they're public, we provide tools for over 50% of the Fortune 500 use Audit Board today to help manage their audit risk and compliance. And I think it's critical that as you go through the process that you have the right ERP, you have the right tools for governance, regulatory compliance, and you have the right tools from the CRM perspective that you can stand up on a quarterly basis and report accurately and on time. And there is, unfortunately, the CEO and the CFO sign off on all the reports, and there are federal penalties, including jail time, if they're misrepresented. So I think it's critical that you make sure that you invest in the right systems and the right partners to make sure that you can do that.
Right partner, right system. How about the right technology? That was a good shift role. Thank you, because it is my next section, technology. Technology is transforming every part of the business, so let's focus on it a little bit, including AI. Emily, where is AI already making a difference in equity comp and IPO prep? And where is adoption still early, if it is?
Well, it's perfect timing for this because I actually attended an AI training just this morning. And certainly AI is headline news across the business landscape. Specifically with respect to equity compensation, where we've seen most of our clients really engaging and using AI is really in the employee communication space. Employee communications, and we haven't touched much on this so far, is so critical to the success of an equity compensation program, especially once you go public and you are granting to a larger population of employees, many of whom may have different varying experiences and levels of financial sophistication. Helping employees to understand their equity programs and what they mean, what it can mean for their own personal wealth creation, when they need to take action, like that's super important to the success of an equity compensation plan. And so AI is a great way that companies can, this is a great space for companies to explore using AI and use it efficiently to deliver more effective communications and personalized communications, the right information at the right time to their employees. We're also seeing AI really be used in terms of data readiness for implementation. I think that this is error identification, as companies are going to need to make the inevitable shift in terms of, solutions and providers for their plans. Using AI to prepare for data readiness and error identification is really a big opportunity that our clients are exploring. I think that we're not quite there yet. It's still sort of in early phases in other places in terms of plan design. Things around plan design and equity compensation are very bespoke for the company's unique needs and objectives. So I haven't really seen much in terms of AI playing a role in plan design, but we're certainly seeing it in communications and data readiness.
Thank you, Emily. And Bianca, can you give me some examples from Hinge's experience? Meaning, like, what practical efficiency examples did Hinge Health see as AI factored into IPO preparation and the investor discussions?
Yeah, so during our IPO process, we didn't rely too much on AI. I kind of wish we had some of the processes that you mentioned, Emily, because it felt very manual with our lawyers and the finance team. But where we have really seen AI add value after going public is on the IR side. It helps us to be more efficient behind the scenes, pulling together shareholder analyses, conducting research to inform our scripts, which frees up time for us to spend on the bigger picture and ultimately spend more time out meeting folks. That said, what investors really care about isn't necessarily IR productivity, but how AI is transforming the business as a whole. It comes up in almost every investor meeting we have, and that's front and center for us, luckily. It's the core of our product is driven by AI, so we've actually been focused on it for a while here. But beyond that, we've also made quite a big push as an organization to weave AI into everything that we do. Which is really helping to drive efficiencies for our employees and allowing them to do much more with the same resources. We're starting to see those benefits flow through in our numbers and the operating leverage that we're delivering.
Perfect.
Yeah, one of the things I wanted to build off of Emily's comments, I also think AI, when you flip it, as a CEO, when you make decisions, you really need a broad-based set of advisors to help you, because all of the employees are now going on to AI and saying, do we have the right benefits for our company? Do I have the right compensation plan? And so they have the power of this information that they never had before, and they're questioning your decisions and asking about other options. And so if you're not leveraging world-class providers across your ecosystem, whether it's for comp design or benefit design, you're going to be on your heels with your employee population. So it's really critical that you're working with best-in-class partners to get the right information, because there's so much information out there. It's not all accurate, but people are using it to vote on how you're delivering benefits to your employees.
Thanks for sharing. That was a question I was going to ask you. How does audit board use AI to improve compliance, transparency, and readiness? And perfect, insightful information. Thank you, Raul. Can we go next to the IPO preparation in terms of the lessons learned? Bianca, looking at Hinge Health's journey, what is one lesson that you would share with other companies preparing for an IPO?
Yeah, I'd say don't underestimate the need for focus. Aligning internally across teams and priorities takes far longer than you would expect. You already heard Raul and Emily go through some of the needs on the structural side and whatnot. So over preparing really pays off. Our company made the call early that it wasn't something that they wanted a current employee to manage alongside their day job. So they brought in someone dedicated to driving that process. So that allowed us to really be thoughtful across the board. We started by running quarterly business reviews that tracked the KPIs we thought we'd ultimately take public. That helped us understand things like seasonality and sharpened how we could talk about the business externally. It allowed us to then go out and be very proactive with meeting with investors, like I mentioned earlier, and doing that over a multiple year time frame. The same goes for the research analyst community. Like, be very focused on who and intentional on who you want to go out and meet, and spend the time getting to know them, so that when you do ultimately hire banks, you have the right roster of research analysts that you want. And finally, like, control what you can. You can't dictate the market, but you can make sure you're operationally and strategically ready. So when the window opened this year, because of all the work we had put in over the last 3 years or so, we were ready.
Over preparing, control what you can, love them. How about Raul, from Paycor's IPO, if I may ask, what's one lesson you carry forward in your leadership today?
Yeah, I think the most important thing, going public, was making sure that every employee shared in the benefits of the IPO. And I think it was really critical. And we went to our board to ensure that we could do that. And we did have an evergreen provision, which was very helpful, Emily. And we were able to do that and make sure that everyone shared in success. You want everyone aligned against the goals. And then secondly, every quarter, after every public call, we would break down for 60 minutes for the entire employee population what went right, what went wrong, and what we're forecasting in the future, what the investors think about us, what their analysis is, to communicate so people can understand how their day-to-day jobs tie to the overall success of the company as a public company.
Thank you, Raul. Emily, what's one lesson? I know it's going to be hard because there are many lessons I'm sure you can share, but if you could prioritize, what's one lesson recent IPOs reinforced about preparation?
Well, I just want, before I give my one lesson, one comment on Raul. Like, it's fantastic that you included every employee in an opportunity to benefit from the IPO, but it doesn't stop there. Like, that same passion for inclusion and giving all employees, future employees who may not have been there at the time of IPO, an opportunity to participate in the company's success really is such an important way to maintain that entrepreneurial culture that you established before IPO well into a public company life. But in terms of like the one lesson, I would just say that it's super important for companies to realize that whatever solution they're using for cap table or equity plan management as a private company, it's probably not going to work as a public company. Your needs change dramatically. You need a broker involved to unlock liquidity. Virtually all companies rely on a captive broker, but not all brokers are equally created in this space. So really making sure that they're working with a broker and a dedicated team with expertise in this space is so important. And I will just wrap that with, like, don't forget about your employees. Like, these IPOs are wealth creation opportunities that may deliver wealth to employees who have never had any experience with wealth in their lives. So they are going to be looking to their employer to help them with financial planning, tax planning, charitable giving strategies. So make sure that you're really working with the right partners to deliver excellent service to your employees, who really are what brought you to IPO in the first place. So I know I kind of stretched it beyond one.
I know it's very difficult, but you did give a 360, really, all of you, from your perspective, from your experiences. And now it brings me to, again, people and leadership. I know you talked about the employees and the people and how we should take care of them. Before we wrap, IPO prep isn't just financial, as you said. It's also about people and leadership. So my question is going to combine the two, because you are leaders now. Raul, from the CEO's seat, it might sound like I'm asking the same question, but I'm asking from a leadership point of view. What's the most important thing for keeping teams focused and motivated through the IPO journey?
Yeah, I think the most important element is to make sure everyone's aligned on what your mission and vision are as a company, what your ICP is, because ultimately that's driving your overall business results. And business results will drive your stock price. And it will either be positive or negative based on your performance. And so I think it's about keeping people focused on the task at hand, and making sure that they focused on reviewing their business results versus the stock ticker on a daily basis. And if you do what you're executing against and what you deliver is what you said you were going to deliver, everything takes care of itself. So as far as leadership goes, it's about staying focused on the business, and everything else takes care of itself.
So you said mission, vision, culture. Perfect. Bianca, how do you communicate culture and mission to investors so it supports the equity story?
Yeah, here at Hinge Health, Raul talked about our mission. Our mission is to help people live healthier, more mobile lives. And that mission is really, the core of everything that we do here, including how we communicate with investors. When it comes to the equity story, we've always approached investor and analyst days like we would a customer conference. You're essentially selling your company, so it's important that everything is buttoned up, credible, and authentic. That's the most important part. At Hinge Health, our members are our top priority. We made that very clear in how we told our story. In our S1, in our investor video, we brought that culture to life through real member testimonials, and by giving voice to the leaders across the company that interact with our members on a daily basis, like our health coaches and our PTs. So my advice to CEOs and CFOs that are preparing for the IPO: don't hide your culture. Bring that to life in any way that you can throughout the IPO process, whether it's in your S1, in the video, in an investor day. show how your mission drives your decisions, how your people live it, and how your customers or members in our side experience it. That authenticity resonates, it builds credibility, and it makes your equity story much more compelling.
Perfect, thank you. And Emily, last question of our day today. Once public, let's talk about after public, right? We always talked about the pre-IPO, the planning, the flexibility, the strategy. But once public, how can companies maintain that entrepreneurial mindset while scaling as a public company?
Well, again, I'm going to default to this, this magic dust of equity compensation. Companies use that as private companies because it's a really efficient way for them to incentivize their employees to work harder and drive company success. But that doesn't end at IPO. Those are things that companies still need to drive as public companies. And a really great way to do that is to make employees owners. And that is what equity compensation is all about. It's about ownership. And ownership is important because we simply take better care of the things that we own. And I say this all the time when people question that. I'm like, well, have you ever washed a rental car? Probably not. Nobody washes their rental cars, but everybody washes their own car. And that's because we take better care of the things that we own. So using equity compensation efficiently as a public company and making employees owners, yes, it's going to look different than when you were private. You're probably going to do it through a different mix of vehicles, probably the introduction of an employee stock purchase plan. But that can be a great way to keep that culture of innovation from the early days living strong through your public company days as well.
Thank you so much, Emily, Bianca, and Raul. Today we heard that preparing for an IPO isn't just about getting the numbers right. It's about balancing investor expectations with company culture, building operational readiness well in advance, and navigating the very real complexities of regulation. We also heard how technology, and especially AI, is already reshaping that journey from equity compensation to compliance. And through it all, the common theme was leadership, keeping teams motivated, communicating with clarity, and staying focused on the long game. With those takeaways in mind, I want to thank our panelists, Emily, Bianca, and Raul, and thank all of you for joining us for Beyond the Bell, Navigating the Path to Public.